We need to talk about oil and how it's about to affect the entire world. Someone shorted the oil market today by hundreds of millions of dollars, exactly 20 minutes before Trump announced that everything was going to be fine. If that happened once, you could call it a coincidence. But it's happened at least 3 times since this war began. That's not coincidence. That's a pattern. The theory is simple. All this back and forth, the strait is open, the strait is closed, wait no it's open again, is a mechanism for insiders to manipulate markets. Last Friday, we were told the Strait of Hormuz was finally open. Oil prices dropped. Markets rallied to a new all-time high. Then over the weekend, it turned out that wasn't true at all. Ships were being rerouted. The strait was still closed. On top of that, something strange is happening to the world's energy infrastructure. Dozens of pipelines have caught fire or exploded, stretching back to March and happening across the globe. And because energy can't flow freely, the IMF is now warning of a worldwide recession if the conflict doesn't end soon. Now, you might think the US is safe because we're a net exporter of oil, but the math tells a different story. We import about 6.3 million barrels a day and export around 4.1 million. That makes us a net importer of 2.2 million barrels a day. You can't be a net importer of something and call yourself the world's supplier of it. This confusion is part of why oil has to completely different prices right now. The paper price, what you see on Google, is Brent Futures, sitting around $100 a barrel. The physical price, what it actually costs to buy a real barrel that gets loaded onto a real ship and delivered to a real refinery, is over $130. That $35 gap is the largest spread ever recorded in history. For nearly 20 years, those two prices moved together, maybe $1 or $2 apart. The only time they diverged this sharply before was during COVID, but that was a demand collapse. This is the opposite. This is a supply emergency. So how much oil is actually missing? The world uses roughly 100 million barrels a day. What's missing right now? Somewhere between 8 and 13 million barrels per day. For context, the entire United States runs on about 20 million barrels a day. We're talking about losing the equivalent of half of America's daily usage every single day for weeks. One energy fund manager calculated the total damage at 780 million barrels lost over the course of this conflict. The entire U.S. Strategic Petroleum Reserve holds about 400 million barrels, and it was already half empty before the war started. So we're looking at losing twice the total emergency reserves the United States spent decades building up. Every alternative source combined U.S. spare capacity, Venezuela, Canada via Pacific routes, gives you maybe 2.8 million barrels a day, against a shortfall of 8 to 13 million. The math doesn't work. Reserves will run out. Which countries are feeling it first? Asia got hit hardest. Deliveries basically stopped on April 1st. Asia sources roughly 80% of its oil from the Persian Gulf, and only about 6% of pre-war volumes are getting through. The Philippines declared a national emergency after fuel prices more than doubled overnight. Indonesia and Vietnam told citizens to work from home. In Thailand, marine fuel costs jumped 250%. The fishing industry, about 1% of their economy, is shutting down. Japan is slowing down bus and ferry services. India stopped LPG supplies for commercial use. In Mumbai, about 20% of hotels and restaurants had already closed by early March. In Africa, the last deliveries stopped around April 10th. Countries like Ethiopia, Zimbabwe, and South Sudan are literally diluting their petrol, mixing it with other chemicals to stretch what's left. Australia's last fuel shipment was expected April 19th. They've already released national reserves, cut fuel taxes, and activated a national security plan. Europe's deliveries also stopped around April 10th. They're in full demand reduction mode. And the United States? JP Morgan says we're last in line. The final crude cargoes reached Texas on April 1st and California on April 8th. That buffer is now gone. So when does this hit us at the gas pump? JP Morgan puts a specific date on it. The last tanker to clear the Strait of Hormuz before the closure left on February 28th. It's expected to reach its final destination around April 20th. That is the moment pre-closure barrels are fully used up from the global supply chain, and after that, there's no more buffer. When that happens, the physical price and the paper price will have to converge. So why is the paper price still low? Why did oil prices actually drop after ceasefire talks failed? The best theory: someone placed massive short positions betting that oil prices would fall right around the ceasefire announcement. They're currently under investigation. A short position in oil futures means you eventually have to either close the contract or actually deliver physical oil. The theory is that whoever placed those shorts may have needed one last window, a ceasefire narrative, to exit their positions before physical reality makes the paper price impossible to sustain. Someone is selling promises of oil at $100 a barrel knowing they'll never deliver it. They're using the paper market as a psychological tool. But when those contracts come due and the buyer says, "Where's my oil?" whoever sold those contracts will have to buy them back at whatever the market price is at that moment. If physical oil is at $130 or $140, that's what they'll pay. That's called a short squeeze, and it's one of the mechanisms that can cause the paper price to catch up to the physical price very fast. What does history tell us? In 1973, the Arab oil embargo took about 7% of global oil supply offline. Oil prices rose 300%. The stock market fell 52% over 23 months. It took 7 years to recover. Inflation peaked at 12.3%. In 1990, the Gulf War took a similar 7% offline. Oil rose 75%. Stocks fell 21% but recovered in about 4 months because the war ended quickly. Mild recession. Inflation peaked at 6.3%. Now look at 2026. Supply offline, 15 to 20%, more than double either previous crisis. Oil futures up over 100%. Physical oil up over 200% from pre-war levels. Duration so far, 7 weeks, with no clear resolution. Even in the best-case scenario 1990 that was a 21% stock market correction and an 8-month recession. Today, the market is near all-time highs, pricing in zero correction and zero recession. Worth noting, in 1973, markets stayed calm even after the embargo was announced. The S&P 500 actually went up 2.3% after the October ceasefire. People thought the worst was over. Then stocks fell another 40% before bottoming. It took weeks for markets to price in the reality because nothing in recent history had prepared them for oil rising 300% in 6 months. That same disconnect is visible right now. Wall Street is near all-time highs. The University of Michigan Consumer Sentiment Index, a measure of how regular people feel about their finances, is near multi-year lows. Those two lines have moved together for years. Right now, the gap is enormous. Historically, it's never been the person filling up at the gas station who was wrong about how the economy felt. And it's not just oil, it's food. The price of urea, the world's most commonly used fertilizer, is rising fast, approaching levels seen during the Ukraine war in 2022 when global food prices triggered political crises across the developing world. Urea is made from natural gas. Natural gas flows through the Strait of Hormuz. Disrupt Hormuz, and you disrupt the feedstock for the fertilizer that grows the world's food. That price increase will work its way into grocery store prices over the next 6 to 12 months. We saw this exact sequence in 2022. Energy prices spiked in February. Food prices followed through the rest of the year. Delayed effect, same outcome. The bond market is telling the same story. Since this war started, 10-year government bond yields in the US, UK, Germany, and Japan have all risen. Higher yields mean higher borrowing costs. For a country carrying nearly $40 trillion in debt, every uptick in that yield costs billions more in annual interest payments. The US 10-year is sitting at about 4.3%. The UK is at 5%. The danger zone, the level at which servicing America's debt becomes a serious problem, is somewhere around 4.6 to 4.8%. Meanwhile, China's bond yields have gone down. For the first time in at least 20 years, China now has lower sovereign bond yields than the US, UK, Japan, and Germany. In a crisis, the world's money is moving toward China as the safe haven. Here's why that matters for the US. The 10-year yield is the rate that everything else in the American economy is priced off: mortgages, car loans, corporate borrowing, credit cards. If oil rises and drives inflation higher, the Fed can't cut rates. Yields stay elevated or go higher. The cost of the debt increases. Deficits grow. The cycle feeds on itself. What was the original plan? The theory is that disrupting Middle Eastern oil flows and cutting off cheap energy from places like Venezuela was intended to hurt China and Russia more than the US. Starve China of Gulf oil, force them to pay a premium, drain their foreign reserves, slow their economy down. Meanwhile, the US, with its shale production and military power, would reassert dominance over the world's energy markets. Here's what actually happened. The US burned through nearly its entire inventory of advanced cruise missiles in 5 weeks. Rebuilding that stockpile requires rare earth magnets and tungsten, both mostly controlled by China, which is not happy. Trump's upcoming trip to China is expected to focus on keeping those rare earth supplies flowing. The question is what China would want in return. The answer is probably oil. Nobody knows exactly how this plays out. Maybe a real ceasefire happens this week. Maybe Hormuz reopens faster than expected. Maybe markets absorb all of this smoothly. But the physical evidence, the JP Morgan data, the bond market, the fertilizer prices, and 50 years of historical precedent are all pointing in the same direction. The paper markets and the official narrative are pointing somewhere else entirely. In every previous crisis, it's been the physical world that turned out to be right. And at some point, you can't print physical barrels of oil. The management of this story in the paper markets stops working when physical reality becomes too large to hide. Based on everything the data is showing, that moment appears to be very close, which means gas prices, grocery prices, and a lot of other things are likely going higher. We'll see what happens.